Hello, world. This is John Pinto, your roving realtor, bon vivant, video blogger, podcaster, raconteur, home chef. And I am here with John Dudek from Sage Settlements. How are you today, John?
Doing wonderful, doing wonderful. Good to be with you as always, John.
Thank you. We have our brand new playlist, Structured Installment Sales. Can we call Structured Installment Sales SIS? Can we do that?
I'd love it. Yeah, saying that over and over is a bit of a mouthful, so I'm all for that.
Okay, so we have four whimsical videos already in the queue. I think with Elvin Bishop's Let It Flow, that's Let the Cash Flow Flow. We got the Beatles' Tax Man. We've got the Kinks' Sunny Afternoon. I'm home in my chateau on a sunny afternoon because the tax man took all my money and I had to sell my yacht. And then we had Peggy Lee singing I Found You Just in Time for those people that need independent living, assisted living, and memory care for themselves, their spouses, their parents, or family. And then we have our first one in the queue on a primer to SIS. Today we're going to do five more videos. And the first one we're going to talk about is structured installment sales for elderly homeowners. Can you give me some preliminary commentary, John, on how structured installment sales may apply to, specifically in this case, two elderly homeowners? They're not widows, they're not widowers. They're both alive, but either one of them or both of them need some level of assisted living, independent living, or memory care. Have at it.
Yeah. Well, I think those are really, really nice targets for the SIS because, as you know, John, in that situation with both spouses still alive, they do not have a step up in basis in their home. So, if they've owned their home for a long period of time, plus 15 years, plus 20 years, they've had a great deal of appreciation into their home. Now they're in a situation where maybe they'd like to go into an assisted living or retirement community, but their retirement income isn't allowing them to do that. They could sell their home, but unfortunately they'd be hit with a massive tax bill in the situation. So using the SIS to defer their capital gains taxes, to lower their capital gains taxes, in many cases, spread out the sale of their home through multiple years to create a guaranteed income stream that helps them pay for not only the retirement care, but also other portions of their life is just a really natural fit in my eyes.
Good. So let's go with the two alternatives that they may be facing. First of all, people in this kind of situation have no interest in converting their primary residence into a rental and then later on doing a 1031 tax deferred exchange. That's just too many steps, too complicated. So that's not going to happen. So what happens is they're either going to sell their house, and it's in the San Francisco Bay Area. It's not a big stretch to think that somebody who's bought their first home in the 60s, I just sold a home where was the original owner, 1966 or
Mhm.
70s or even 80s, and it's highly appreciated. The basis in the property may be less than 100,000. The property may be worth well over $2 million, and depending upon your $500,000 exclusion and sales price and improvements to the property, you could be looking at what is a 37% tax bite if you just sold it for cash. Is that correct, John?
That's right. Yeah. As we've discussed, the tax brackets in California, especially, you got to look at the federal, which is can be as high as 20%. Then the state tax can be as high as 13.3%. Then you've got a Medicare tax that applies throughout the country. That's an additional 3.8% over $250,000 of gains. So add that all up, you're 37.1% on that sale of your home. That's, as you said, can appreciate in the seven figures.
All right, so let's talk about a couple of things. First of all, there's the impediment of people even needing the care being reluctant to move out of their houses just because they've been there for 40, 50, 60 years or whatever it's been. But then another impediment, once you get past that, is paying all those taxes. And I know for most California homeowners that I know, they would rather have their bodies and limbs ripped apart by wild animals rather than sell the house and pay 37% of their profit on federal, state, and Medicare taxes. What's your commentary on that?
Well, I'm not going to disagree with you. I know people don't like paying taxes, no matter what your political affiliation is. I think everyone's against that. And yeah, there's certainly some people in my area as well. I'm down here in Southern California where a lot of these towns down here in the San Diego area used to be sleepy beach communities where you could frankly buy affordable home 20, 30, 40 years ago, and now they've all turned into these the kind of big mansions or whatever you want to call them. And people that own those homes for that long, they'd like to maybe move out of state, they'd like to move into an elder care facility, whatever it is, and they can't stomach the tax bill that they're going to get.
Yeah, so let's get into the weeds on it just a little bit. Let's say that somebody's selling a property and their taxable event, in other words, after you calculate what they paid for the property, how much improvements they made on the property, their $500,000 exclusion. In cities like Los Gatos, Saratoga, Portola Valley, Burlingame, Hillsborough, Atherton, Walnut Creek, it doesn't take much before you're looking at a $2 million gain. So if you did sell that house and you were realizing a $2 million gain, then the conventional wisdom would be that you would take the 63 cents that's left after paying the 37 cents on the taxes and then invest it in something to subsidize your care. Can you explain how it would be different if somebody opted for a structured installment sale?
Yeah, so essentially what you're doing is taking your full sales price, investing it pre-tax. So that's as you said, you're taking 100 cents of your sale price instead of 63 cents and investing it into what's called a structured annuity, where essentially you're taking that amount and you're annuitizing it and taking the money over time as opposed to taking it in one lump sum. And the advantage of that is due to IRS Code 453, which we touched on our previous talks, you can do what's called an installment sale or the installment method of accounting, which says you only pay taxes on the money you receive in a given taxable year. So you can imagine if you had $1 million worth of gains that you were that were going to be taxed, subject to capital gains, instead of having $1 million in year one, you could spread that out over, say, 10 years. And instead of that $1 million in one year, you'd have $100,000 subject to cap gains over 10 years, which knocks you out of that high federal rate. It knocks you out of the high state California rate, eliminates the Medicare tax altogether. And so by doing proper planning with your CPA, with your advisor, with your realtor, you really, really, really start seeing some tax savings. And on top of that, outside of tax savings, you're earning interest on your pre-tax sale instead of your post-tax sale. So you're kind of getting a double whammy, save money on taxes and get the extra interest on that full ball of wax.
Good. Cream with a cherry on top. So let's drill down into some specifics. So the magic number for California residents, you're in Southern California, I'm in Northern California, is if you are receiving $250,000 per year. And that is taking into consideration what your Social Security and your retirement income is and subtracting that out. So let's say you have 50,000 in retirement and Social Security. That means the structured installment sale should be 200,000 or under to reduce your federal tax bracket from 20 to 15, your state tax bracket for 13.3 to 8 and completely eliminating the 3.8 Medicare tax. Is that accurate?
Yeah, I mean, I believe it would take you on the state from about 13.3 to I think it's the 9.3 bracket if you're in that area. And this is the part of the podcast where we give the disclaimers that neither one of us are CPAs for your listeners out there. So we like to work with your CPA when we're doing these calculations. But yes, you've categorized it very well. Eliminating that 3.8% net investment tax is obviously something that you want to do. Now it's 250,000 if you're married filing jointly, anything over 200,000 if you're single. So something to keep in mind that if you're not married and you're filing single tax returns, it's a lower threshold. But you just kind of look at how long can you spread this thing out? How much income is it going to generate? What are your immediate needs? What other income you have? I mean, there's all those factors that we put into our models and work with your trusted advisors to make sure we're doing what's best for your specific situation.
And from a quote unquote legal standpoint and a practical standpoint, how many installments does a structured installment sale need to have, or does it normally wind up having?
Yeah, so the to do the installment method of accounting, it says you need to take at least one payment for your sale in the tax year following the sale. So make it real easy. If you're gonna sell a property in 2024, at least one payment from that sale needs to happen in 2025. So you could theoretically just cut it in half and take half in 24, half in 2025. I think when you start, running our models, when you start getting the taxable advantages and getting those really lowering your brackets, it's anywhere from 4 to maybe 10 years where you really start seeing the advantages. Obviously, if you want to spread out your sale over 20 years, 30 years. I think you can do it up to 40 years if you're kind of looking at some estate planning or, passing wealth down to your kids. If you're looking at that, you can look at it. So the longer you spread it out, the lower your annual cap gains is going to be, or subject to cap gains is going to be, and you can really, really get down into some small percentages. But I'd say on average between 4 and 10 years is where that most people do it.
And I'm going to guess that the term is driven by the preferred income in the financial model to get you under the federal, state, and Social Security threshold. So as long as you stay under those thresholds, again, taking into consideration what your Social Security income is and your retirement income is, you're going to go up to, but under the caps, and then amortize it over how many years it takes to amortize your annuity back in your pocket. Is that accurate?
That's how a lot of people do it. They look at it that way. Others, some of the people listening to this podcast they have significant other income, and so it's not going to be as much of a tax lowering strategy as much as a tax deferral strategy. And earning interest on those pre-tax dollars is important, and you're also deferring taxes. But I think for the majority of people, yes, you kind of look at, hey, where can I get into these more favorable tax brackets? And then we do the work and say it's going to take you 7 years based on the sale of your home and based on what your adjusted basis is. Or sometimes it's 4 years, sometimes it's 10 years. And it's very flexible, a lot of different ways we can do it. We can show you different options. But I think those are the sweet spots, as you like to say.
Right. And year one, the year that you close escrow, really is no different than the ensuing installment years. You still want to keep your net proceeds that you take from the sale under that threshold amount. Is that correct?
Yeah, yeah. I mean, each year is treated exactly the same. It's basically whatever your, basis compared to what the sales price is and what percentage of that is subject to capital gains that affects you in year one, just like it does in year two, three, four, five, six, seven, and so on.
Okay, good. So we'll just summarize for the homeowners that are sitting out there thinking, in my world, being a realtor for 50 years, I think that the way you do this is, first of all, it's an aha moment. Ooh, I can do this. This is great. This is a great option. This is exactly what I wanted. I want to get out of the house. I don't want to pay a lot of taxes. I want to create an income stream to subsidize my current quote unquote independent living situation, which could move to an assisted living situation, which eventually can move to a memory care situation. I want to find a facility with all three of those options available. Let's get together with Sage Settlements. Let's have our CPA and our tax attorney bless the financial model. Once we get all that down, then we're in a position to list the property. We know we're going to approach it in this way, and the listing and the structured installment sale are intertwined in all of the paperwork between the realtor, the seller, Sage Settlements, MetLife, if MetLife is the one that's going to be committing to paying the annuity, and also the buyer, the buyer's agent, the buyer's lender, and the title company insuring the deal. So that's all storyboarded and financially modeled in advance before the property goes on the market. What do you think about that, John?
I think that's the best way to do it. I mean, you just mentioned a whole lot of people that are going to be involved in this, the advisors that you're going to want to run this by. And so having that all taken care of prior to listing works a heck of a lot better than telling the buyer, a week before escrow that, hey, this is what I want to do if you're a seller. Same thing if you're a buyer. If you're a buyer and you're looking for ways to put a unique offer on a house or an investment property, maybe get a little bit of a discount on that property. You want to let the seller know that you're willing to do this sort of transaction. And I think you hit on something really well. It's an aha moment. It's something that very few people know they can do. This is another option. Everybody knows about 1031s, or most people do. A lot of people know about DSTs, but you can't do a 1031 with a primary residence. And if you want to turn it into a rental, I mean, you mentioned at the top, how long would that process take to turn a primary residence into a rental property?
It's a multiple year operation, because usually what you're talking about is turning the primary residence into a rental property, and then trading it into multiple smaller properties and then selling those over a period of years. It's just too inconvenient, too time consuming from a practical standpoint. No matter how good you make it sound for tax savings, most people are not willing to subject themselves to all of those moves.
Sure. And I mean, kind of what we're speaking to, people looking to get into assisted living, maybe they don't have 2, 3, 4 years to go through that process and make a 1031 possible. So this is a much simpler solution in that scenario.
Right. And just wrapping it around, individual people's situation. Let's say you've got a couple that has owned their house for decades. It's highly appreciated. They're in their 80s, maybe even in their 90s. One of the two couples is still moving around pretty good, pretty capable. The other one is more at risk in the house, especially of a fall, which could result in, best case, a broken hip, worst case, banging your head and getting in a coma, and you need to get out of that environment. The more healthy ambulatory of the two is having enough of a struggle just taking care of themselves. They just don't have the bandwidth and the capacity to take care of the more diminished spouse. But because they're both still alive and married, they don't have the stepped up basis. So they're kind of like in a box. If they sell the property, they're going to have to pay that 37% in taxes. So I think structured installment sales, in my opinion, is going to work the very best for elderly married couples that are looking to move into independent living, assisted living, or memory care, or all of the above over a period of years, and transfer that frozen equity into a tax advantage cash flow, which could facilitate their living in a proper environment that's going to be safer for them with more support. So I can't overemphasize what an important tool the structured installment sale is for people in this circumstance. Can you put your exclamation point on this group for SIS?
Well, I think you did a great job doing it for me, but yeah, no, it's just another tool for people in that situation to utilize, something that they probably didn't know existed, something that they can explore. Financial will help you with the financial modeling. We'll work with your trusted advisors to make sure this is something that is a viable situation, the right situation for you, and maybe opens up some opportunities to live out those golden years in a better situation than you thought was possible.
Absolutely, positively. Very good. So thank you all for tuning in. This is part of a series, so feel free to check out the other videos in the series. Some of them are just whimsical, entertaining, short videos of a minute or less, bringing the idea of structured installment sales to consumers. Others are more drill downs, like this conversation that John Dudek and I are having. So please do uh, click, like, share, subscribe. I think I got it all, don't you think, John? I think that's all the
Those are
buttons.
the main three. Yep, that's right.
Notifications is another one. Very good. Thanks again for watching. Bye for now, and we'll see you on the next video.